A lot of ICT traders struggle to identify daily bias. They understand the concepts and the models, yet still feel confused when the market opens. Without clear direction, they overtrade, second-guess themselves, and lose money. But once daily bias is clearly defined, trading becomes easy. In the next few minutes, I'll explain daily bias in the simplest way possible. So in this video, I'm going to show you my exact three-step process for identifying daily bias. This is the same process that has helped me become consistently profitable over the last couple of years of my trading career. By the end of this video, you're going to have a very clear market approach. You'll be able to sit down at the charts and already know your bias before you even think about taking a trade. This is not about predicting the market. This is about becoming an observer of what the market is already telling you. Once you understand this, you will never be confused about daily bias again. Before we get into the actual process, I want to share something important with you. I was not always like this when I first started trading. In my first 1 to 2 years, I would easily spend 12 hours a day staring at the charts. Most of the trades I took during that time were not high probability trades. I was constantly trying to figure out what the market was doing at every single moment of the day. What I eventually realized was this: you do not need to know what the market is doing all day in order to make money. And this is where a lot of new traders struggle. Many beginners think that if they don't understand what the market is doing at every moment, then they must be doing something wrong or missing some important information. But the reality is very different. You only need clarity on a very small portion of the market's behavior. That small portion is enough to give you an edge. In my experience, you really only need to understand maybe 5% of what the market wants to do. Everything else is just noise. Our job as traders is not to figure out what the market is doing all day long. The market is going to do whatever it wants to do. Our job is to recognize when the market is giving us a clear direction or bias, and then align ourselves with that. Most traders complicate this process. They try to combine multiple strategies. They wait for one confirmation, then another, and by the time everything lines up in their head, the opportunity is already gone. They end up overanalyzing, second-guessing, and missing the trade entirely. So, in this video, I want to cover all of that. I'm going to show you my main approach, how I personally view the market when I sit down in the morning, and how I look for trades within that process. The most important thing I want you to understand about daily bias and taking high probability trades is the difference between predicting the market and observing the market. Like I said earlier, our job is not to predict what the market will do all day. Our job is to react when the market clearly shows us what it wants to do. Once you understand that mindset, trading becomes much calmer and much more consistent. So without further delay, let's jump straight into the process and break it down step by step. All right, so now what I'm going to do is pick a random point in price action and walk you through exactly how I build my bias on a day like this. The very first thing I do is a complete top-down analysis. When I'm trying to form a daily bias, the main thing I focus on is this question: where is the draw on liquidity, and where does the daily candle want to expand toward? To understand that, you need to understand why the market moves in the first place. The market moves to hunt liquidity, rebalance inefficiencies, generate liquidity, and return to equilibrium. So when I look at this range, the first thing I do is go up to the weekly time frame. On the weekly, I'm not looking for entries. I'm looking for context. I want to see if there is any higher time frame PD array, like a fair value gap or imbalance, that price could be reacting to. Here, you can clearly see that we have a weekly fair value gap that price has started to trade back into. This immediately becomes the foundation of my bias. At this point, I'm not asking where price is going all the way in the future. I'm asking a much simpler question. Where could I reasonably expect to see a reaction, a rejection, or a rebalance? And right now, that answer is the weekly fair value gap. When I look at the price action inside this weekly fair value gap, I can see that price has generated a lot of internal sell-side liquidity below, So I mark that out as sell-side liquidity. When I look to the left, I don't see very clean external liquidity being targeted yet, but we are clearly trading inside an imbalance on the weekly time frame. So now I have a higher time frame reason to expect a reaction. Next, I move down to the 4-hour time frame. This is where the bias starts to get refined. Now here's the important part. Having a bias does not mean the market is immediately going to do what you expect. The real question is when the market is actually ready to do it. And that's where liquidity sweeps come in. Because we are inside a weekly fair value gap, if I want to look for bearish price action, I want to see buy-side liquidity taken first, followed by displacement back lower. As I look at the 4-hour chart, I can see that a high has already been taken. So I mark that as a buy-side liquidity sweep. Now my bias becomes bearish. Not because I want it to be bearish, but because of the context. We are inside a weekly fair value gap, and buy-side liquidity has been taken. To me, this looks like manipulation. Buy-side liquidity gets taken, which often opens the door for a move back toward sell-side liquidity. So now I'm expecting price to sell back lower, especially since we are already inside a higher time frame imbalance. With that context in mind, I move down again, this time to the 15-minute time frame. Now I'm no longer trying to decide bias. The bias is already there. What I'm waiting for now is confirmation. On the 15-minute chart, I want to see some form of bearish confirmation. This can be anything you are comfortable with. In this example, we can see a change in the state of delivery and an inverse fair value gap forming. This is very important. Just because we are in a weekly fair value gap does not mean we short immediately. And this is where a lot of traders make mistakes. Many traders see a higher time frame imbalance and immediately start looking for shorts, but sometimes the market continues higher before it actually turns. What matters is not where the market could react, but when the market is ready to react. Now that we have a change in state of delivery and an inverse fair value gap on the 15-minute time frame, this tells me that the market is actually starting to show bearish intent. Even if I missed the initial sell-off, that's completely fine. What matters is that now the higher time frame and the lower time frame are aligned. The market has now confirmed to me that the bias is bearish. So at this point, what am I looking for next? I'm looking for manipulation higher. We already have a 15-minute inverse fair value gap, so I want to see price rebalance into that inverse fair value gap, take out buy-side liquidity, and then continue lower towards sell-side liquidity. This is how I build my daily bias step by step, without guessing, without predicting, and without forcing trades. I simply observe what the market is telling me, align with it, and then wait for execution opportunities. So now, once price has swept the 15-minute buy-side liquidity, this is where I want you to shift down to a lower time frame. You can use whatever lower time frame you are comfortable with. There is no fixed rule here. Personally, I like to plan and execute my trades on the 1-minute time frame, so that's what I'm going to use in this example. Once I move down to the 1-minute chart, my focus completely changes. I'm no longer looking for bias. The bias is already decided from the higher time frames. Now, I'm only looking for an entry confirmation. As I observe price on the 1-minute time frame, the moment price closes below this bullish candle and forms a bearish order block, that becomes my point of interest. This bearish order block is showing me that lower time frame sellers are stepping in, aligned with the higher time frame bearish bias. So what I would normally do here is place my order directly at that bearish order block. For my stop loss, I place it above the recent high to keep the trade protected. For targets, I don't overthink it. I usually target these equal relevant lows that are sitting below price. Now let me zoom back out and explain the reasoning behind this trade again, because this part is very important. On the bigger time frame, the market is clearly bearish. We are inside a higher time frame imbalance. We've had a change in state of delivery. We've had an inverse fair value gap. We've also seen internal manipulation of the buy-side liquidity. All of these things together tell me that this is a high probability area to look for shorts. So when I see a clean lower time frame entry confirmation, like this bearish order block, that's exactly where I want to participate. And if you watch how this plays out, you can see how price moves cleanly lower and our target gets hit exactly as planned. This is how higher time frame bias and lower time frame execution work together in a very simple and mechanical way. So what we are really doing here is aligning the bigger time frame first and identifying an area where we can reasonably expect a rejection. We are looking for manipulation and intent, not random entries. What I really want you guys to understand is this one key idea. For the market to go lower, it almost always needs to go higher first. And for the market to go higher, it usually needs to go lower first. This is extremely important. So any trade that you see me take, I always need to see liquidity taken in the opposite direction first. That is non-negotiable for me. Now in this example, my daily bias is bearish. So what am I waiting for? I am waiting for a move higher. I want price to move higher to rebalance the inefficiency that we are expecting price to reject from. I want to see price run into that area, take buy-side liquidity, and show signs of exhaustion. And that is exactly what happens. Price moves higher, it takes out buy-side liquidity, and then we get one final push higher. After that push, price closes below the 1-minute change in state. Once that happens, price comes back up to rebalance the bearish order block, taps into it, rejects it, and then finally delivers the sell-off we were waiting for. Now let me zoom out and connect this again to the bigger picture. On the higher time frame, we already had a clear reason for bearish bias. We were inside a weekly fair value gap, and we saw a change in state of delivery. That gave us the context. Because of that displacement on the 15-minute time frame, we also formed a 15-minute inverse fair value gap. So now my bias is clear. I am bearish, and my target is sitting at these equal lows. But before price can go down and take those lows, it needs to manipulate higher first. So I patiently wait for that internal manipulation to the upside. I do not rush into shorts just because I am bearish. Once that manipulation happens and price gives me lower time frame confirmation, that is where I look to take my short. And that is the exact sequence. Higher time frame bias, manipulation in the opposite direction, confirmation, and then execution toward liquidity. This is how you stop guessing, and this is how you trade with structure and intent instead of emotion. My biggest piece of advice is this. You will be the most successful as a trader when it feels like you are doing the least amount of work. That might sound strange at first, but this is something I learned the hard way. When I first started trading, I did not trade like this at all. I was constantly forcing ideas. I would get attached to my bias and start thinking things like, price is going higher, this looks perfect, everything makes sense. And I would enter a long trade just based on that feeling. And then I would get stopped out. This would happen multiple times in a single day. The worst part was that by the time the actual high probability setup finally showed up, I no longer had the conviction or even the capital to take it properly. That's when I realized something important. Trading should not feel like you are fighting the market. The reason this approach feels effortless is because you are no longer trying to tell the market what to do. You are waiting for the market to tell you when to enter. My job is not to predict. My job is to observe. Now, I only need a loose understanding of bias. For example, if I'm bullish, I know exactly what I want to see. I want to see sell-side liquidity taken first. And only when that sell-side liquidity is taken do I even consider entering a trade. If price does not take the low and just runs higher without giving me that liquidity sweep, then there is no trade for me. And I am completely okay with that. I don't force anything. I don't chase price. I simply wake up the next day and look for the exact same thing again. Another very important thing you need to understand is that not every level on your chart matters. Not every fair value gap you see is something you need to trade from. What really matters is understanding price action manipulation and understanding where the draw on liquidity is. That's it. You need to know where liquidity is resting, where price is likely trying to go on the bigger time frame, and where you can expect manipulation to happen. In this example, my bias is bearish. That means the draw on liquidity is lower. So the opposing direction to that draw is bullish, which means I need to identify where buy-side liquidity is resting. I wait patiently for that buy-side liquidity to get swept. And once that happens, I look for my short trade in the opposite direction, targeting the draw on liquidity on the bigger time frame. This is how trading becomes calm. This is how it becomes repeatable. And this is how you stop overtrading and start letting the market do the work for you. I hope this video helped shift the way you think about trading and helped you understand why doing less often leads to better results. The goal is not to be active all the time. The goal is to be patient, let the market show its hand, and only step in when everything aligns. If you focus on liquidity, manipulation, and where price is actually trying to go, you don't need to predict anything. You just react when the opportunity is clear. Stay disciplined, trust the process, and don't force trades when the market isn't giving you a reason. If you found this video helpful, make sure to like the video and subscribe to the channel. If you want to connect with me, you can join my Telegram and Discord. The links are in the description. And if you want to learn personally from me, you can check out the mentorship program. The link is also in the description. That's it for this video. I'll see you in the next one.